Good afternoon to you in Europe. Good morning to you in the States. It is Wednesday, the 28th of September, nearly at the end of quarter three and also nearly at the end of the month as well. It's been a busy old September, Shane, and 10 minutes before the open now for the US cash market, and all the talk pretty much yesterday was about these new home sales in the States. Far better than expected.
Yeah, new home sales came in hot. We're about 685,000. We were only expecting a print of about 500,000. Previous release was 532. And just by taking a quick look at the MBA 30-year mortgage rate this morning, one of my big indicators, not listed as a market mover, but a huge indicator for me regarding debt and really a big ticket item consumption like a home. We saw 6.5% this morning. Yesterday's big time number, big time overperformance in this area definitely tells me this is the last stand. This is the bonanza. Everybody that's getting into a home that is right now because they're afraid of those higher interest rates. And it really speaks to what the Fed's doing with its monetary policy, what the world's doing, taking a hawkish stance towards inflation. And I think that yesterday's big time print should have been a bullish market driver. We didn't see that. I think everybody sees trouble on the horizon, and it stems from these interest rates. 6.5% this morning, Nick. 6.5% on a 30-year. That's huge. Week over week, down 3.7% on our MBA mortgage applications. We're starting to see an inflection point in this housing market. It's always been a leading recessionary indicator for me. I think that we're right on the precipice of seeing a major downturn, and we saw a lot really develop in the overnight in England in the gilts market, Nick.
Yeah, very much. I mean, it has been, just the data has just been off the chart. It's just the rate, the pace at which things have been happening is pretty incredible. The Bank of England today, they came in and they intervened in the gilt market, and it was a real shock in sense of there was literally no warning at all. If we have a look at gilts themselves, you can see we just literally spiked within seconds on news of the announcement that the Bank of England was going to prop up the gilt market and was going to intervene. Obviously, demand for sterling instantly off the back of that. In reaction to the tax cuts that the UK government tried to put into the system at the end of last week, we have seen such a massive fall in sterling. Just to quickly give everybody the specific details from the Bank of England statement, they said that market pricing has become more significant over the past day. Will carry out temporary purchases of long-dated gilts from today. The purpose is to restore orderly market conditions. So they're clearly not happy. We stand ready to restore market function and reduce credit risk. Purchases will be carried out on whatever scale is necessary. Now, this is not a form of quantitative easing. Apparently, this is all coming from reserves. But if we check sterling itself, I mean, the move in sterling today is like just your average 300 pip intraday move there, Shane. Really, really quite incredible moves.
Yeah, that's fantastic action. That's one of those you hope you're on the right side of it, Nick. And usually, if you find yourself hoping, you're in big trouble. So that kind of volatility, even though it's not quantitative easing, that tone, we will do whatever is necessary to restore order. I mean, what a statement! Absolutely, what a statement. So,
very, very much a kind of like a very. It just paints a picture. And with you saying about the new home sales from tomorrow, what it says to me is that particularly guys that are new to trading, we can look at that kind of data coming out of the US and we can say, okay, well, there's clearly nothing wrong with house sales at the moment, but when you put in the context of saying, hang on, people are worried about their mortgages going up, they're all literally stampeding through the door, that is not a good sign.
no, it's not. It means that there's major uncertainty on the horizon. I won't call it a tidal wave or a perfect storm or anything like that, but I will say the lending environment is changing dynamically. I mean, these folks are involved. The bankers of the world are involved, and it's important to keep a close eye on your squawk, keep a close eye on your news feed. For instance, we have pending home sales coming out here in about 35 minutes. The market's looking for about a 1.5% downturn here on the back of last month's 1% loss. We don't know if we're going to get that. We don't know if we're going to get that. My guess, judging by yesterday's new home sales, is that this number is going to come in a little bit better than expected. Now, how will that impact our equities open? We still have the VIX up over around 33. It's really a challenging environment to get any read off of what are traditional fundamentals. We have to be able to put them into context, like you said, Nick.
I mean, let's just have a quick check on that VIX reading because, just run us through it, Shane. How does that work as for people that are new to trading and don't fully understand how to use the VIX as a tool to help them in understanding equities?
Yeah, the volatility index, I mean, that's Wall Street's fear gauge. I'm sure that most traders have heard that. But the biggest thing to remember is that we're pricing deferred month S&P 500 options contracts. We're trying to gauge the implied volatility in the market. Now, implied volatility is what traders expect to happen down the line. It's not what's happening today. So typically we see a rise in the VIX when the markets come off. But this is a forward-looking indicator. And the biggest thing I would recommend to new traders, don't get bogged down in the minutia. It's a difficult calculation. There's a lot of secret sauce in there.
Yeah.
When the VIX is elevated and high, you just need to be wary. That means there's a lot of angst in the market. So right now, today, let's take a look. Pre-market, we're trading right around 32.91. We're right around 33 in the VIX. Remember, our Russian invasion of the Ukraine really spiked the VIX, brought a lot of uncertainty to the markets, and that reading was about 37.86,
Yeah.
38. So we're not in panic mode just yet. But the angst is palpable. I mean, there is angst in these markets, and traders don't necessarily know what's coming our way in the next month or 6 weeks.
Yeah, very much so. It definitely is one of those things. It's part of what a suite of tools that are labeled as market internals, and it's a very very handy tool. To but what you've got to be very careful of is people don't need to use it as a direct trading tool. The VIX goes up, so therefore I'm going to do this. It's just one of those gauges. But what is also very worrying, has been sort of in the last 24 hours, Shane, is this Fed watch. I mean, let's just run us through how you use this information on a day-to-day basis.
Yeah, the Fed watch. Anybody that's watched one of my live streams is probably tired of looking at this chart, Nick. But I'll tell you, it's very important. I've been referencing it for probably the last 6 years, almost religiously. And what this is these are derivative traders pricing futures contracts regarding interest rate levels. And what we've seen here over the past several days is we were pricing in a 3/4 point rate bump at about a 70% chance
Yeah,
of
yeah.
that occurring. It was about 70-30, and this has been really a quantum leap from where we were just a few days ago. And now we're looking at about a 55.8% chance, 56. It changes all the time, Nick. Yeah, this is one of those things you constantly updating if you're watching it. But the biggest thing to remember is we're at about 50-50 now of a half-point rate bump in November as opposed to that 3/4 point rate bump. And that is a major, major shift in tone,
Yeah.
specifically from our expectations of what the Fed is going to do.
Yeah,
And
I mean, when we came out of the last FOMC meeting, it was kind of like they pushed that hawkishness right into 2023. And originally, if you read back like sort of like 8 weeks or so, the Fed, the little, I think the dot plot was basically pushing expectations to be a 50 in November and a 25 in December. And by last week's FOMC, that had completely gone out the window. But now it seems we've got another seismic shift again.
absolutely right. It's uncertainty, uncertainty, uncertainty. Not to
Yeah.
mention we have an election coming up in about a month. So, I mean, there's just a tremendous amount on our plate. If you don't enjoy these kinds of markets and trading in this environment,
Yeah.
boy, maybe find another profession. That's what I would say.
I mean, it had been very much kind of like we'd had such a dead summer. I mean, it really felt this year like we had a very, very, very lackluster summer. And just those last couple of weeks of August, it was just like you could feel the volatility it felt like it wasn't quite what it should be. You couldn't feel those big positions going into the market, and everybody like in the trading room as well. It's like we need some action. We need some action.
Yeah.
Well, we've had it. We've had action. It's almost like people are at the other end. They're almost exhausted. They want a bit of a break.
That's one of the good things about trading. If you play the action right, you just go on holiday, right? You go on holiday for those dog days of summer. But we knew there was a storm coming our way this fall, and boy, it is here. The
It,
volatility is immense. It really
very much
is.
so. It seems to be literally across the board. But as we turn our focus now to the cash equities, obviously Wall Street is gonna open in about 2 minutes time. So we're looking, certainly on the S&Ps and the Dow itself. We've been the offers are being lifted at the moment. If you just reference the Dow itself, key level for me on the Dow as we go into today's session is this 29.5 area, which was a really key swing top in 2020. If we do get a push up to there, I'm going to be very curious to see if the bulls can hold above it. We've been up there a couple of times this week already. It's acted as resistance every single time.
I think it's a fantastic area. I mean, for me, it's that 2020 panic COVID lows to those all-time highs in the Dow. I have 38% retracements right in the neighborhood of 29, 8.25. So we're right in about that 300-point vicinity, Nick, where I'm firmly expecting heavy resistance there. That was a key support level for me, really throughout the spring months when we saw the big sell-off, and then we had the nice rally back in the summertime, and that seems like ages ago. We're right back down. We're beneath that 38% level, so that's a big time resistance zone for me, potentially a weekly top, potentially a daily top today.
Yeah, I think it certainly could be. We are now, equities have just opened in the States. Let's have a quick check on the S&P 500, keeping on a fast time frame, which is always a good thing to observe the open on. And as it currently stands, well, it's not a hugely volatile open to the session, but I suspect that we are going to be just figuring out which way to go at the moment.
Yeah, I mean that's sort of a scratch open. That's what I would say. I mean we have no direction right now. So if you're an early day trend trader and you're trying to get in on these breaks early after that opening bell on a 1 minute chart or a 5 minute chart, might want to let the dust settle for just a bit here.
Yeah.
I mean this is whipsaw action. We saw it yesterday. We saw it Monday. Caution's the better part of valor. You don't you don't want to run in there and bet it all on a 1 minute break. Let the dust settle a little bit.
I mean, I'm certainly looking for on the S&Ps itself. I would honestly be able to see some kind of a relief rally in our midst, just given how volatile and how bearish everything has been. But we are now printing under on the daily on the S&Ps. Well, yesterday the last 2 days we have spiked under the lows of June 17th, coming in at 36.36. Next support for me down there is at 35.81, which is key resistance from the COVID-19 year 2020, September 2020. That would be the next port of call for me, and I wouldn't really want to call it with the way specifically whether that would hold or not. I suspect. I mean, I'm a MACD guy myself. I very much like the momentum on a MACD as a useful barometer, and I can't see anything on there that points to the upside for me at the moment.
No, this is incredibly bearish. Very similar analysis to the US 30. We've broken beneath that 38%
Yeah,
range, which is right up around 38.15. We're firmly on the bear. My next support level for me, a macro support level, is 50% of that COVID range.
yeah.
2020's low to those all-time highs, right around 35.05. And I'm always a fan of big round numbers. So anytime a technical lines up right around something like a 3,500, I'm all ears. My eyes light up.
Yeah, yeah. It's going to be an interesting session. What is on the calendar for the rest of the day? There's mortgages out today, isn't there? Is that right?
Yeah, we've got our mortgage numbers in just a little while ago. We've got pending home sales coming out here in another 27 minutes, and we already covered that with expecting a downturn. Don't be surprised if that number comes in better than expected, and if new home sales is any indication. And also crude oil. Crude oil is always a big one for me. The end of the weekly inventory cycle from that API release Tuesday afternoon to that EIA release Wednesday mornings. And yesterday the API came in with a large supply build. We were
Yeah,
looking at about 4.15 million barrels. This morning we're looking for the EIA crude oil inventory report. We're expecting about a half a million, 0.443 million barrels. I don't know. Right now we're in fall seasonality, Nick, and we really need to see those supplies build. We need to see those go up
yeah.
as we're already pricing those wintertime crude oil futures contracts. So if we see another big supply build on the heels of the API, if the EIA number comes in robust, 4 or 5 million, 6 million, it's going to be a bearish market driver for
Yeah.
crude oil.
Yeah, I would absolutely agree with you. There's been no traction on the Iran nuclear deal as well, which of course has been also a key driver for crude oil at the moment. And also, interestingly, I've not heard anything on the Russian oil price cap. So those are two big seismic macro events which will be affecting crude oil, and we've not seen any of those yet. Our analysis on crude oil has been pretty close to the line, pretty close to the close to the line. This 75 to 76 range is holding very nicely. Currently, our low sit at 76.20. Both yourself, Shane, and I, we both have a view of 75. It keeps going around in my head like a mantra. I honestly think that we potentially could get a touch of 75 before we get a meaningful rally from here. But as yet, nothing.
Yeah, I think that we've come an awful long ways to not test 75. So I think that our price is going to hit 75 at some point. Of course, when, that's the $1 trillion question. But if we do get sort of a rounded bottom, maybe some price exhaustion down there at 75, that could potentially be an intermediate term bottom in this market. Like Nick said, our technicals are spot on, right? That range right around 76, 75 down to that 76 flat level was just spot on. So feeling pretty good about this market today. We'll see where that number comes in, and if we do get a little bit of bearish participation on a big supply build, perhaps we get 75 ahead of Q3 rolling into Q4. Will not shock me to see heavy participation and heavy action in the crude oil markets for the next 48 hours.
Yeah, absolutely. Final one, really, just as just reference now, is the gold market. Now, I've had a very active interest in gold. I've finally taken my profits on a short position overnight, so I'm very happy with that. But what's interesting, some of the dialogue over the last 24 hours is the uptick in gold usage in China and India. Religious festivals coming up in India. Of course, in India, they're very, very big consumers of gold. And also the COVID restrictions that are starting to ease in China have started to help the repricing of gold on the international market and on the consumer market and the wholesale market in China. So there's a bit of an uptick in demand starting to occur in gold, and we're starting to see that now just play out against the price action. Bear in mind, of course, as well, that on gold itself, we have monthly support coming in just at around about from 2020. Hope everybody can see that coming in at 1611. We just didn't quite get there this morning on the drop down before the candles started to base, but it is definitely a key monthly support area from here.
Yeah, I mean, definitely. I'm still looking bearish, but it's one of those things, Nick. You talk about having a short position in gold with a fantastic entry.
Mm.
How long do you let these things play out, and do you really want to go for the ride back up to 1700 and fiddle around until Christmas?
Yeah.
I don't know that. I don't know that that's the play. I mean, for me, I'm looking at 1585 to the downside as being a formidable support level, but right now, still very bearish. I don't know that I would hesitate stepping in and scalping this 1689s if we get a chance there. But those are short-term trades. Those aren't anything you would hold for any length of time.
Okie dokie. So quick check on S&Ps, how we are now currently sitting as we're just over 5 minutes into the session. Well, it is a relatively quiet open on Wall Street. No doubt things will be picking up, and we are still sat just within the range, key ranges for the week. So that 36.36 holding up quite nicely at the moment. Okay, so if you are joining us on YouTube, it's good to see you. Thank you very much for your company. It is very, very welcome. Just to let you know a couple of the things that are going on here at ForexSignals and how to trade. We have our new Academy to Career Funded Trader program, which is now launched. We have some guys that are now sort of like funded traders trading $50,000 up to $2.5 million of our real money.
Yeah, it's exciting to see some traders get in there, and we've had the opportunity to watch these folks develop really in the trading room over the course of the past few months, and they're getting ready to go live. They've got their head to the grindstone. They're watching their fundies. They're watching their technicals. They're ready to get in there and play for some real money. And I think that that's probably the biggest thing that makes our Academy to Funded Trader program unique is you will be trading real money. When you earn, you are an asset. You are managing the firm's capital, and you are an asset. You're generating returns, and that's a lot different than a lot of programs out there that are let's just say that they're sort of geared around video game trading is what I call it.
Yeah.
So this is the real deal. 180 days. The Academy, I believe, is dropping next week, isn't it, Nick?
That's right. Yeah, the first phase of the new Academy content is being released at the end of this week into the start of next week. That is hopefully going to be a body of work that's going to grow over the next 12 months and be a real game changer in retail forex education and trading education. Really helped really from a two-pronged approach to help guys that are completely new to the market and have no idea where to start, and also get experienced guys that want to make that step from bedroom retail trader up to professional prop trader. It helps them through that journey and supports them all along the way. So that's a very, very exciting development indeed.
Oh, fantastic materials. I've had an opportunity to review a lot of the psychology materials, and good stuff, fantastic stuff. We're excited about that, and it's going to give people the ability to get in on the ground floor and say, okay, I don't know anything about trading. I'm going to get in, I'm going to learn, and I'm going to progress and actually build a career in the market. So I have a fantastic program. We're excited about it.
It is going to be good. And the final thing to quickly mention as well is do not forget, if you are not part of our community, it's worth joining in for a trial membership, because we have one of our experienced traders, Mantis. He is doing his second part of his exclusive live streaming with us on this coming Friday during the UK European session. Mantis comes from Australia. He has a real expert in understanding understanding what drives the Asian session, and he has a very unique trading strategy that he has a lot of success with called the Mantis Reversal Claw trading strategy, which is a fascinating look at the markets, and he's going to be doing a real deep dive on that at the end of this week on Friday. So if you want to get involved, please do hop over to the website and sign up for membership. Okie dokie, that is it for today. Thank you very much for your company. Lots going on in the markets, and yeah, keep that wrist tight. Shane will be coming up later on with a stream, and we will catch you all tomorrow.